Welcome to Markets Now. I'm Michelle Rook with John Payne, Hedge Point Global Markets. We've seen some mixed trade this morning in grain and livestock futures trade, and currently we've got corn and wheat higher, soybeans seeing a little pressure as well as cattle, but hogs are holding onto some firmness. And John, let's start off with the wheat market. All three exchanges are now trading higher, not just SRW, but some of this might be short covering. Some of it is tied to confirmation of some of this China export business, right?
Yeah, I mean, I think any additional wheat buys from the Chinese markets are not priced in here, or at least they weren't priced in. You look at soft red wheat in the mid to low fives. That's going to be value territory, and for whether it be folks who want to buy it just to store it, give it a carry, or folks like Chinese who need to use it, have a lot of alternatives right now. And even in the case of hard red winter wheat, if the effort of the market or the board, so to speak, is to keep buyers away, they need to do that because you're seeing prices at the KC markets kind of narrow down and get to levels where it makes a lot of sense for, we might see Egypt come in again and buy. Freight matters right now. We've had problems in the Panama Canal, and then you've had problems on the Mississippi River. So any wheat that can go out the Pacific Northwest is going to be there to discount. And I would say that for corn as well. I would expect the U.S. corn to be moving, maybe not hand over fist here, but the Mexicans continue to buy, and I wouldn't be shocked to see a Chinese purchase come in here. Brazil is very expensive over the next couple of months relative to the United States.
Yeah. So how much more wheat business do you think that we'll get? I mean, is China also buying because maybe we're not moving as much out of the Black Sea region, or what?
Well, that's part of it. The alternatives of where they're going to buy from are dry. Australia's had a really tough year, so they're kind of back in the soup again when it comes to deficits. And Argentina, which would be one that you could go to, they're just such a mess on the export stage right now. I don't think they're dependable sellers. The U.S. is, if you're hungry in the world, and kind of look at this like any restaurant you go to, they are the 24-hour per day Denny's restaurant. You can go in there and get a good meal anytime, and it's going to be delivered. The question is, you might have to pay a little more. So maybe Denny's isn't the best example, but in the case of U.S. supplies right now, if you need it tomorrow, you need to come to the U.S. because you're going to have to line up quite a while in the South American sector. And really, there isn't a whole lot else out there right now in the Pacific Ocean that's going to satisfy demand. So I think that we've hit levels, prices. I'm not saying that the market's going to shoot higher here. I think the carry is a significant problem for the long side. If you're going to own corn and own wheat, corn to a certain degree, but wheat definitely on the soft red wheat, you're buying into a massive carry. You're going to have to hold, talking about almost 10 cents per month in storage costs. And the market needs to substantially rally for that to make sense for the speculator to come in and buy. So I think that's bearish on face value, but it can also be bullish in the sense that we're not factoring in a lot of purchases here. So you get news like today where China buys on a surprise move, the market's going to perform, and that's what we're seeing. So the hard thing is going to be, where do you sell and when do you sell into this if you need to sell it by the end of February, which I would imagine a lot of folks do to raise bills for the coming growing season.
Yeah, so that'll be a little headwind if we get this pickup in farmer selling. But the funds, when you put the three exchanges together on wheat, are record short here. So, if you get a short covering push here, could you get 50 cents out of the market, or what are you thinking, John?
I think $1 is possible. I mean, I wouldn't be shocked to see us run $7, $7.50 on the KC. Not to mention here, I haven't talked about Europe. Europe's off to a very poor start for their growing need. I think they got 85% planted, which by December 1, you think of any wheat farmers out there in the northern hemisphere, you don't get your wheat planted by Thanksgiving, you're not a winter wheat farmer. You're going to either hold it for the spring or plant some spring crops, and that's what we're hearing in Europe as well. So, I think there's plenty of room for this market to move higher. Not to mention that you've got other asset classes that are starting to bubble a little bit, and that's more in financial sense. But wheat is a market that I would always be kind of aware in my older days, I guess, if you want to call it that the hedge funds want to own it in the winter because there's crop loss potential, and it's a good way to hedge winter weather to a degree. So I think that we found some lows here, and didn't surprise me. It was right around first notice day. That squeezes out all those longs in December and forced them to make that decision to roll to March. And I'm sure some guys tapped out and threw in the towel. Don't blame them. But then we get the rally as soon as that's over, and now we have a couple more months to pry it out of the farmers' hands.
Yeah, and that same thing you mentioned, first notice day liquidation, that happened in the corn market as well. We scored new contract lows last week, but obviously that was a good point for end users to come in here. They saw value. We saw more export business to Mexico this morning. So is corn getting its own legs under it, or is it just following wheat?
I think a little bit of both. I think corn's got value here as well for the reasons I mentioned earlier with
Right.
just where we compete on the world stage. You have pretty much two stores open right now. You've got a Brazilian store that you can buy corn from them, but if you want to buy it over the next 2 months, you're not getting it. I mean, it's going to take you quite a while just to get to the port itself. So if you need corn, you need to buy it. The second thing you have is a discounted basis in a lot of parts of the country, and Mexico's going to take advantage of that. They've got a drought as well going on, and their feedlots are, to a degree, hemorrhaging cattle. Just given the margins that we have, they get those as well. So they're trying to raise their herd, and they don't have any feed anymore. So they're going to start shifting calves north, and they're going to need to, get as much corn as they can to keep what they have on hand. So those are all bullish signs for corn. I think for me, you look at the spread between December and March. I think that went up to 22, 23 cents. And, my partners here, we talk about that every day, where it's like astonishing how wide that is.
Right.
And then you look at May to March, and we're at 11. So, are you bullish March? That's the one I'm a little more like, I might spread March against May and then buy May. As I think May will give you that kind of spring pop that either comes from a lack of U.S. acres combined with what's going on in South America. And we haven't really gotten to the weather part of South America yet. We talked about their soybeans over the past couple of weeks, months, about how it's been slow to get in, but that problem is going to be a snapback in the spring when the U.S. has when the Brazilian corn needs to get planted. And I think that's where May for me, if you're going to buy options, I'd like May a little better. If you're going to buy flat price futures, it's probably one or the other. It doesn't really matter. But again, that spread, if you want to be hedged a little more, maybe you don't buy that 11 cents under spread because it could go to 18 on delivery in February, and then May stays a little bit more steady. I just don't see that market going to an inversion at this point. It'd be a hard thing to see given the supply we have on hand here.
Yeah, we haven't seen this carry for a long time in that market.
Ever.
You mentioned,
we've never seen it like that.
Yeah. So you mentioned the Brazilian crop, and let's talk about it in reflection or in reference to soybeans, because soybeans are not following corn and wheat here today. And I know we've run up into some chart resistance, but we're also looking ahead at the Brazil forecast, maybe a little change there, and some things bubbling up on China, right?
Yeah, I think with the bullish side of it, it will be Brazil. I mean, they're starting to see write-downs. A couple of firms went down to 159 today. So we started at, let's call it 165, 163. You're going to start to see that come down, maybe down as low as 155. And that's where we think the low will be. We've got some good kids, I call them, that are down there doing long division math on this stuff and watching it very closely. So they think 155 there. They're a little more bullish on corn, but they think the bean yields are going to be there. The question we have is really on the demand side, and that comes from one, crushing demand. Crushing demand is really good here in this country, and it's really good in Brazil as well. Argentina, not so much. They need to basically kind of increase and play with their currency markets to get that to move. That'll be some uncertainty here as the president takes over at the first of the year. Then you have China. And China, this is where hogs come in. So you'll get a big liquidation we've seen in hog prices on the Dalian exchanges going back 2 weeks. And that came in conjunction with an announcement that they were going to stockpile pork. So, that tells us they're planning on shrinking hog herds in the future. So they want to buy more pork rather than grow more pork. It's good for our growers, probably good for the growers in Brazil. But what it's not good for is the folks who are exporting soybeans to China, as their margins are negative. They probably don't need as much. So that's on the margins there. Given where beans are on the new crop, you kind of wonder, do they need to go up anymore to pry away corn acres from the growers here in the U.S.? And I would believe that corn's going to shed some acres here at these prices. Just looking at the break evens provided by the University of Illinois, we're basically in the low fives, according to their math. So we'll see if that comes to fruition or not. But it's going to be tough for me to stare margins in the face like I'm seeing, as a buyer of grain. For example, a chicken or a turkey plant, like they want to buy. The margins are great here. They're going to be in the market buying, and it's one of those. A bird in hand is better than two in the bush. And right now there's a bird in hand. So I think you're going to start to see them come in here and start to buy some DS24 as well.
Gotcha. What about cattle? Some new lows there. How much more pressure do you think we're going to see in that market? And for feeder guys, is this a buying opportunity?
On the second part of your question, I think it's a buying opportunity. I think it's a buying opportunity last week as well. So, you can't pin me down to a price. I would say, here in the low twos for the front months, margins pencil very well. I think you got to pay attention to the live side if you start to hear live continue to trade at 170, 175, in Texas, that April board is too cheap, in my opinion, on the live. And that then puts margins more in the positive if the board goes up. And right now, crush margins for April, so using the April feeders with September corn and December live, so that spread there is at highs. So the feedlot margins are expanding here on this break. Not to mention, I'm not in a packing plant, but I would imagine packing margins have gone up as well. Beef prices are pretty much steady. So I think this is an opportunity. The question is, in the short run, can you handle these huge vol movements? And our analysts and our traders here made a note this morning of just massive put buying on the open. And I don't want to quote the number. I think it was something like 2,500 to 5,000 puts bought in a market like feeder cattle is a lot. And they were bought all within the first hour of the market across all the pillars. And that tells me insurance buyers are coming in here. And for me, I kind of operated under the idea that late to the party insurance buyers tend to be wrong over the longer run. Maybe not over the short run, but over the longer run. So I'm not saying we'll shoot back up to 250 right away, but I think March feeders at 215, April feeders sub 220, August feeders specifically down around 220 are all, in my opinion, green lights if you have the gumption to do it.
On live cattle futures, you think we'll see much more pressure though?
I mean, you're speaking feeders or live? I'm sorry.
Live cattle, do you think we'll see more pressure?
Maybe a little more pressure just to get the margins positive, but I mean, we've come in quite a bit over the last couple of months, and I think that these guys are going to buy. I look at where beef is right now. The fact that we're cutting rates, that's going to put more liquidity in the market, and the consumer is still somewhat strong here. So I would say beef prices should stay here between 280 and 300, which should put margins square, in a decent level relative to where they've been over the last year. And I think that April live will see 180 again. Don't hold me to it, but that'll be an assumption I'll make.
And instead of hogs, I want to talk about gold. We're at record highs. Yep. Obviously, the market may be looking ahead thinking we're going to see some interest rate cuts, but is that really going to happen with what Jerome Powell said last week about, hey, don't get too carried away here, folks?
Yeah, I think the problem is there's a problem that can develop from the idea that rate cuts are coming. So if rate cuts are coming, you want to buy assets now and then refinance those when the rate cuts come. That's typically how a lot of guys will do it. So that creates inflation in itself. So if you have everybody cutting rates, markets like gold and Bitcoin and cryptocurrencies have certainly done well. Any assets that are fixed are going to do okay. So I think that from the standpoint of commodities, we're in a place where I think you're starting to see the cost of production pressured. You're certainly not seeing more animals created. We're slowly trimming our herds in hogs. We're slowly trimming our herds in cattle. The corn markets, I don't know if we'll get additional acres year over year. Beans are a different story, but anything that's fixed, like cryptocurrency, like Bitcoin or gold, you're going to have those assets prices do okay. And especially given that not only the Fed is cutting, but you're going to see Europe cut as well. So, it's kind of it's like who has the cleanest dirty shirt in the laundry, and they all kind of look dirty. Then you're going to have markets like gold and Bitcoin do okay.
All right. Thanks for your analysis as always.
Thanks,
John Payne with Hedge Point Global Markets, and that's Markets Now.